Friends, in this video for ithought Advisor, I'm going to talk to you on a topic, improving returns. Everybody wants to do better than what they get. We are not going to be resting on what returns the market gives us. No matter where we began, when we began, what the market was when we began our investments, we want to do better and better. Better than the market, better than our peers, better than our expectations, and better than what we imagined. So, betterment is something which is our primary goal. But do we really try hard enough to get better? Do we really make the effort that is needed to better performance? This is something which most of us don't ask ourselves. As an investor, I work constantly on specific investments to improve my investment performance in that investment and also at the overall portfolio level. So there is a two-level approach. How can I improve performance at the individual investment level? One thing is, when performance doesn't look good, or worse still, it starts looking bad, then the first response is to make sure that my conviction is higher at that point in time. Because you bought an investment, it's gone down, then it becomes even more favorable in terms of valuation. So, if I am able to raise my conviction further through better application of mind and effort, then I am ready to do more investing on that investment. So, the first thing one should do is improve your conviction when valuations become even more favorable. But conventionally, if somebody bought a stock on a tip from another friend and it goes down, what does he do? He starts doubting it. He starts doubting the source. He thinks something is wrong because price is seen as a validation of correctness of the idea. But as an investor, I don't believe in that. I believe in validating the idea even more sharply and then coming up with a well-reasoned outcome. A judgment which is sharper, which is more focused and which is more accurate because prices are more in favor. Sometimes you may revise your judgment. There could be something which happened between the time you bought and the time you tried to increase your conviction. That is when the stock prices are down. So, that exercise has to be done. There is no point in doubting whether we did the right thing and wondering whether we could be doing something that leads us to a bad place. Getting validation and then forming a judgment and then deciding what to do is one of the basic ways in which you deal with an investment which you began at a higher valuation and which you find has lost significant value. So, in any special situation like the Ukraine crisis, or in a situation where inflation starts going up, interest rates start going up, market starts going down, this is the first port of call for every investor. As you constantly revise and review your estimates and measure your conviction, then you come to decisions which you can implement thereafter. Price alone should not be the guiding force towards decision making. So, measuring the investment and re-evaluating it when it fails to fire is the first step. Once you are convinced that the investment is right, but the market is mispricing it, then you go and see where that investment should fit in your overall portfolio. If you own very little of it, you can consider adding more. If you own a lot of it, then it becomes difficult because you have to come to an assessment as to how far you can buy the same idea. What's your ceiling? Once you fix how much you can own, then you make incremental decisions to increase your exposure if your conviction is higher. If your conviction is lower or if your conviction has changed, then you decide what to do with the investment. In most cases, it would be to exit at the appropriate time. It could be immediately or a little while after. Once you decide where the stock idea should be positioned, even after it has fallen, then you know where it fits into your overall portfolio scheme of things. And once you fit a stock in a portfolio context after it has fallen, then investment actions can follow. So, you don't look at price and then come to investment action. You repeat validation. You repeatedly revalidate your ideas when they fall, and you appropriately respond to the new findings which you have. So what if you had a different view 1 year back? Take a fresh view. Now this is very easy to say but very difficult to implement. But that is what one should do. If you have an advisor and he has told you to invest in a particular theme and it has fallen 20%, then ask him for a revised assessment on that and what can be done with it. Get clarity for yourself, and the moment you get that clarity, then you may be willing to do a few investment actions. What I have seen with most investors is that if the price goes up, then they think they have made a good investment, and if the price goes down, they think they made a mistake. Neither can be taken for granted, because investments which lost initially turned out to be big winners later, and this applies as much to mutual funds as it does to direct equity or even to ETFs. So the approach has to be very structured. Go back to the drawing board, test your conviction, validate it, then decide where that idea fits in your overall portfolio context in the present, and then decide how much more you can buy of the same idea. Find out where you are going to get the resources to invest upon that idea, and finally implement what you have made as a decision. This will lead to betterment of returns, because when valuation is more in favor, you have bought into the right idea and scaled it up to the right position size. If you feel the idea has failed and if you feel it has no hope, then you decide how to exit and then replace that idea with a superior idea, and that also will lead to betterment of returns. Betterment of returns happens by continuously applying our minds at the individual investment level and at the portfolio level. By doing this constantly, we improve bet sizes in existing investments, we create space for new investments, and we fuel the portfolio and power it when valuations are more in our favor. So it calls for a continuous action-based approach. Judgments will always have to wait, because you cannot simply decide on the movement in prices alone. You need to understand the fundamentals each time prices are moved and then decide what works best for your portfolio. As advisors, this is exactly what we do at the individual investment level and at your portfolio level. So we would reach out to you with what we think is best, and you need to act on the same. What I have seen is that investors who understand the thought process and act sensibly within reasonable time tend to better their returns better, while those who are going to be indecisive and waiting for the valuation to come back to a comfort zone are going to miss those opportunities where they could have potentially bettered their returns. When the chips are down, it's an opportunity to better your returns by doing little things incrementally and improving your position size and getting more value out of your savings. This, in essence, is what we all need to understand and implement in our investing. Thank you for watching this video.